The tax base, generally a tax base of an asset will follow its value for tax purposes. I'm talking broadly here. So if you have a CGT asset, most of the time, like for example, a loan receivable, the tax base will equal the cost base, which will equal the carrying amount. For depreciating asset, it'll normally equal the tax written down value or adjustable value. Trading stock is whatever the value you use for tax purposes, and often it is cost. On the liability side, all right, on the liability side, it will either be equal to the carrying amount on your trial balance, or it could be zero. And how do you differentiate this? Is to ask, do I get a deduction when I pay that liability? So if you got a bank loan, when you pay that liability, there is no tax consequence for it, right? So the tax base will equal the carrying amount. If you got a liability that is, you get a deduction when you pay it, and if you could think in your mind, what are some of those? So they would include provision for annual leave, long service leave, accrual for superannuation, accrual for audit fees. You get a deduction only on payment. There's a future deduction. The tax base would be zero. So that's how you determine it. If you like, you can use the formula here to work out the tax base. And I won't go through it. I'll let you have a look at it and try to apply this formula if you need to. So let's look at a simple one. Annual leave provision of 100,000 and a provision for government fines of 200,000. So I want to use a formula. So tax base of a liability, I start with whatever is on my balance sheet, and then I need to deduct any deduction that I'm going to get when I pay that liability. So annual leave, the carrying amount is 100,000. What deduction do I get when I pay that annual leave provision? I get the 100K. So 100K carrying amount minus future deduction, 100K is zero. What about government fines, right? So tax base for fine provision, you start with carrying amount and you ask, do I get a deduction when I pay that provision for fine? No, I don't get a deduction because it's denied under the tax act. So the deduction is zero. So the tax base is 200. So the reason why I put this here is to I guess explain that just because you call something a provision does not mean that it is the tax base is zero. You need to work out whether there is a future deduction or not. Okay, so that's the tax base, and carrying amount minus the tax base equals a temporary difference. For reviewers of calculation, note that the temporary difference can only be one of four things. One is an unrealized gain, is an unrealized loss, is a future deduction, or future accessible amount. So the temporary difference means that it's one of these four things. If it's not, then you might need to get a preparer to recheck the tax base calculation. Okay, so we discussed temporary difference. The other side of a temporary difference is a non-temporary difference, something we used to call permanent differences. So those are things in your tax reconciliation statement that does not reverse in the future years. So things like fines and client entertainment. So temporary differences, you note that some temporary differences represents future deductions for you. We call them deductible temporary difference. And some are future accessible amounts. We call them taxable temporary difference. When you multiply them by the company tax rate, you then get your deferred tax asset for a deductible, or deferred tax liability for taxable, because it's taxable in the future. So it's a deferred tax liability. But before you do this, you need to consider the recognition exceptions and the initial recognition. Sorry, the recognition criteria and the initial recognition exceptions, which we're going to discuss. So for a taxable temporary difference, you must recognize the DTL unless the initial recognition exception applies. For a deferred tax asset, though, apart from the initial recognition exception, you need to ask, is it probable that I'm going to use that future deduction or a loss? So whether it's a temporary difference or a loss, you use the same recognition criteria. You need to ask, is it probable that I'm going to use them? And you note that for capital losses, it's a little bit harder to satisfy, and we'll discuss that.